Thank you, everyone. Thank you for to the panelists for being here. Uh, Today, we are going to discuss about a very critical aspect of any startup's life, which is going public. We have someone who's already done this today in the panel, and we have a very early stage investor here with us. And, of course, the legal fraternity is also being represented. So, this panel, we will start with a hypothesis. And this hypothesis, I take ownership for it. You can deny it, you can debate it. We are at a time when the exuberance in the public market is at a high. And a lot of startups are going public, trying to get the valuation multiples, rather than actually being in the journey of their life when they should go IPO. I would first start with Amit. What's your take on the hypothesis?
So I think, Pratik, from our standpoint, it's very clear that you need to be extremely clear on why you want to go public, right? I think there is a whole life, there are many, many companies who do extremely well in the private domain. So to go public, your reasons have to be very clear. Obviously, in our case, we were an institutional-backed startup. Peak 15, Sequoia, initial days, then Chris Capital and a family of offices. And at one point or the other, when you are taking money from the institutional investors, they need an exit. And the primary way to get somebody an exit is an IPO or a strategic sale. For us, I think it became very clear. We were into about 9 years of our journey. About a year ago, we started thinking about it. Typical institutional capital patience is about 9 to 10 years. We saw the market opportunity was great. We were hitting the right scale, which is approximately 100 million. We were about to go profitable. Last 2 quarters, we have been profitable. So we were hitting all the check boxes of scale in terms of revenue, profitability as a business, scale in terms of market size. We are the largest co-working operator in the country today in terms of network. We're almost 185 plus locations. So we were hitting all the check boxes that would allow us to do that. And the biggest opportunity in our case was that we would have been, when we decided to do it, we would be the first co-working company in the world to successfully go public, and we did it. So I think that was a huge, focus for us. So, yeah.
Congratulations, Amit. That was a big achievement. Neeraj, the thing is, you have within your portfolio startups which are looking to go public. They have spoken about it in the public domain as well. Do you agree with my hypothesis?
Yeah, at least there is a belief both sides. At the investor side also and at the founder side, for the first time, I think, more than any of the last passing years, probably, I think the self-belief of that, yes, I can go public, I think it starts from there. At least founders should be first, have this kind of conviction, and then the rest of the things follows. And when you think of actually going public, the first prerequisite is that you need to have a profitability or at least a path to profitability. And that's what basically we were talking to Amit also just before this session, that they were very clear that when exactly they want to do it, and it's like a 2 to 3 years of like your homework before you go there. But at least this idea of that, yes, I can go public, I think from there it starts, and I think from that sentiment I can tell you that we are right now like 100 plus companies in our portfolio. So the most performing 25 companies out of those, if I just talk about them, they have realized that in case they are looking at this viability of going public, then they need to address the profitability issue also, and which is anyways a boardroom discussions in any of the stages, okay? Even at the angel stage or institutional stage, Series A also, people are looking for these answers, okay? So at least we are sync in at least that direction, that people are now thinking of more sustainable business models, they are thinking of profitability, and I think from there, talking about IPO is a logical, basically, okay, a roadmap. So I can tell you that out of those 25 companies, there are like 5, 6 companies which are very, very seriously thinking of going public at some point of time, and within 2 to 3 years. So portfolio companies like Blue Smart, Zip Electric, HESA, Garuda Aerospace, these are few companies which are now working on scale. Blue Smart is like almost $78 million ARR. Zip Electric is $60 million ARR. So they have scale. Only thing is that if that scale of, which is a basic minimum benchmark is $100 million. So at a $100 million revenue ARR, if you can be a profitable, then it is two big tick marks. Then there are other things also in terms of compliance, regulation, how good you are in terms of your rest of the things. But I think these are the two primary checkbox. So if you are somewhere, say in the journey of anywhere from $20 million onwards in your revenue, I think that is the first basically time they feel, yes, it is just now 4 to 5x of that number that I need to go in next 2 to 3 years. And if I am like almost like close to EBITDA, so then the second tick mark is also there. And I think from that, it's just a belief, okay? So good thing is for the first time, I just want to summarize it again on the same thing, that both investors, people like us, early stage investors, मतलब मुझसे किसी ने अगर 3 साल पहले पूछा होता, will you be a part of these discussion with your portfolio companies, and I would have not imagined it. But today we are in very, very serious discussion of actually like creating that roadmap with our portfolio companies, and we are bringing experts like Amit and legal counsels like Khaitan and company, who are anyway our partners and associates. We are seeking their advice that how our portfolio companies can go into that. So this is a very serious, practical, viable option of exits, even at an early stage, Series A onwards. It's a good discussion, and it's a good sign for the ecosystem, yeah.
No, absolutely. And I think this brings me to Sanjay. So what is the advice that you're giving?
Cautious optimism. See, this euphoria is good, and a lot of positive things are emerging out of it. And we were chatting in the green room earlier that one has to plan for all possibilities. At least as a lawyer, one advises that. And also, I think there is always a wave that goes on, right? There was a wave 10 years back, and I've been in this ecosystem for 13 years. I used to do public M&A in Bombay, and I moved to Bangalore in 2012. I thought that I will never do public M&A again, listed company work again. But now we have it here because I started doing tech company work. And we worked with the government of India through iSpirit to create the Innovators Growth Exchange back in 2014, 15, 16, right? Where tech companies could list without profitability, without too much disclosure. And we did not find many takers for it. So we thought, okay, tech companies don't want to be listed. They don't want that level of disclosure and accountability, this, that, and they want to focus on private fundraise and then eventually getting M&A. But the discourse changed a few years back, and now we are where we are. And right now there is a lot of market acceptability, and valuations are at really, really high in the public space. But one doesn't know when one has to change the journey from IPO to M&A. Right? Nobody knows when that flip will happen. And therefore, if we are talking about early stage companies and founders who are thinking of a journey, every founder starts with a product mindset that this is my product, this is my company, I will scale up. If scale goes to an extent where I can list, then I will list. If it doesn't, then I will go M&A route. But the way you approach the journey is very different for both. For instance, the moment you start thinking of listing, like we discussed, 2-3 years ahead of the journey, you need to figure out how your cap table will eventually look like, how your ESOP will look like. ESOP policy, whether it will be a trust-based policy, non-trust-based policy, there are a lot of companies in which you have founder incentives, which are called MSOPs, and key management. How does that interplay with the SEBI regulations? Because the regulations under which you operate as a privately funded company are very, very different. And suddenly when you start thinking of IPO, then it's a sea change. A lot of discussion on your SHAs is around liquidation preference, anti-dilution, founder lock-in, this, that, etc. Right? But when you talk about companies which are going to be listed very soon, the discourse is slightly different, right? Because then there are who will be the promoter, for instance? Nobody thinks of it at a Series A level. It's assumed that the people who are coming to the VCs for the check are the promoters. But as the cap table grows, as you're nearing that IPO window, then those real conversations start happening. And also one more thing, that it's a lot of management time going into planning the listing, right? Because you start 2-3 years ahead. So a lot of management time will go in figuring out these nuances. And therefore, one has to be prepared for all eventualities later on. And many things will go positive, some will not, and there you again come back to the old LP dialogue, old M&A dialogue. So yeah, my advice is cautious optimism. Yes, we should go for it, but we should plan for the other side of it as well.
So Amit, that brings me to you. Like for a founder's journey, it changes a lot post IPO, right? It's like a quarter se quarter tak is what they say, from being in a very different kind of a mode. How did you, like, from your practical experience, maybe the audience might benefit, how did you go through that transformation?
So first, I think Pratik, the treadmill went from speed 6 to 12. So I think, but on a lighter note, but I think on a bit more serious note, I think I think we were very clear probably 4 or 5 years ago that this was something that we wanted to do. And from our standpoint, we were blessed to have some of the best funds in the country, some of the best family offices backing us. And the journey obviously was quite tamil to us, right? Because if in COVID, we pretty much, most of the industry went bankrupt, right? People were not sure if they will come back to offices. And if nobody showed up at the office, then there's no business to be had. But I think it did 2, 3 things for us. We, as a sector, we got the tailwinds, which basically meant that people adopted co-working in a big way, and essentially the enterprises, which were the largest consumption of commercial real estate, they became adopters. Earlier, they were fence sitters, and we saw that trend earlier than others, and we were 50 locations in March of 2020. Today, we are almost touching 200, right? So we used to add 5 locations a year. We started adding 5 to 7 locations every month. So I think we took that. Second, we kind of completely reshaped the business and said we will become a platform, which means that anything that a commercial real estate user requires, we will build it. And the third was the supply strategy. I think in India, people talk a lot about demand. And I explain it to people, when you have 1.4 billion people, if you are solving a need, demand will never be a problem, right? But that also creates opportunity, and there is no barrier to entry for anybody. So we completely rethought the whole process from a supply standpoint. And this was against the headwinds of the, the big ship, global ship that went up and down, right? Every time the valuation would go up there, people would write our obituary. Every time the valuation would go down, people would write our obituary. So I think you need to be very clear as to what business have you built. And if you have that differentiated business, then people will, kind of listen to it. Coming to going public, I think we started the journey in July of 2023. We wanted to list before the election results were announced. We listed on May 30th. Lessons learned, I think, is the best thing that we did. Before going public, about a year ago, our market cap was 880 crores, because the private guys, they love to keep your valuation down, right? Because they get more, percentage of shareholding. Today, about a couple of weeks ago, at the share price of 946, we touched a market cap of 6,200 crores in less than 3 months of listing. So I think one of the best things that we ever did. And then the final advice there would be that you have to be very sure if you want to go public, because the scrutiny goes up in a completely different fashion. Your governance level, your compliances, it takes a lot of effort to do things which in the private space you do not even think about. So you have to be very clear. We obviously were prepared for it, and we put all the elements in place. And then the final piece of advice, if you want to go public, hire the best. Khaitan was our lawyer, so I would advise you to hire the best to get this done.
That's very valuable insights. Neeraj, the point is, today, the founders who are in the early stage of their entrepreneurship journey, they have, idols to look up to, right? Like the Zomatos of the world and others. When you're working very closely with them, and you mentioned that, those conversations also revolve around going public, maybe in a 4 years, 5 years, 10 years kind of a horizon. How are you structuring those conversations, and how are you kind of helping these early stage founders to go through this journey of from a Series A to all the way to an IPO?
So as I said, I think apart from the initial, self-belief, okay, then the real journey starts. So I think it starts with the self-sensitization actually of the founding team first, okay, and then their core leadership. So few things that they need to start respecting more is, as Amit said, the governance, the compliance part of it. I think the regulatory challenges, and they need to understand all of that, okay? It's not that they can just hire someone and feel that, okay, now they will manage it. I think founders have to learn that craft, need to try to understand and read between the lines, okay? And that's where I think you need professional help of someone like Khaitan. They can come and actually guide you, prepare you for that. So there is a lot of homework that goes on a personal coaching standpoint of a founders itself. Forget about the business. So the founders have to elevate themselves actually to that level that yes, I'm answerable to even those aspects which may not be my priority list. Me as a CEO of the company or me as a co-founder of the company are just looking at growth and numbers and okay, only the margins and things like that. But now I think even your smallest of the documentation that you are doing, okay, the contract that you sign with your vendors, the employment contracts that are going on, as he said, ESOPs, founders incentives, all of those basically becomes very, very high priority. And I think that's where a lot of homework and a lot of personal coaching and I think sensitization needs to be done. So that's one bit that I think is coming across, okay? Even this is learning for us also as investors. We were not sure about, okay, that what guidance we can give you. We had never seen that journey. But now some of our early portfolio companies are like either doing pre-IPO and IPO, and like we have mentors like Amit, okay, who has done that, been there. So I think we are inviting those people to have a very small focus group conversation with these, like I just mentioned about these 5-6 companies. So what we are doing is like we are very actively now encouraging the communication at least among these 5 founders. That let them take a kind of like collective learning and wisdom, okay, how to like navigate this entire journey. And it's like it's very, very different for each one of these companies, for example. Now, like HESA is one of our portfolio companies. They posted 100,000, so 1,000 crore of gross transaction value of, okay, but their margins are, okay, pretty much less right now. But the scale is huge, okay. How they can optimize that? Is there a way that they can look at the accounting principles in a very different way? How they can, lot of money which was not going through the platform, can they just build an ecosystem where like the money start flowing from there? There was a lot of cash basically involvement in their business because they are working in the rural e-commerce. So these red flags, like you need to completely take out the cash component out of the business. Okay, those small things. Now this may not be a problem with a company like Blue Smart. Probably I think there is a asset heavy, okay, business model which they have proved everybody wrong in that. But now they are thinking of their whole positioning is very different. Okay, they are talking about decarbonization, okay, and they're now more talking about a mobility company. So the whole positioning actually has changed, which is suiting to a larger institutional investors, global investors, and probably suiting to the IPO story also. So whether it is branding, whether it is personal sensitization, it is compliance, regulations, all of this, and most important, I think those founders who respect money, others' money, I think those are the founders who will navigate this faster and better.
Yeah, that's that's a very interesting point. But Sanjay, I'll come to you. Like, while obviously these are very important aspects of any founder, at the same time, structuring of deals is something very critical, right? And you have to go through multiple rounds, and you have to ensure that your shareholding gets protected so that you can have a proper say. And we've seen that not happening in many companies. Has anything changed with all the experiences that the sector has gone through? Are founders more careful about that? What kind of conversations are you having there?
Absolutely. I think I briefly touched upon founder incentives, upside share. These are the conversations one would have in the old school private equity pre-IPO deals, right? Because in the traditional businesses, every private equity firm investing would want the company to be listed. In most cases, they were investing in listed companies themselves, which was not the case here. And therefore, whenever one talked about MSOPs in a VC funded deal, one would generally think about an extension of ESOP, which is not the case. Like, both under Companies Act as well as under SEBI law, you cannot give incentives to founders. Under Companies Act, and we have been able to get it through, again, an iSpirit effort and Khaitan effort, where we work with the government, and founders have, of startups who are recognized startups, they can be given ESOPs, right? But SEBI still has that restriction. So therefore, on this one example itself, if you're operating in the private space, round after round, because what happens is founders get super busy during the fundraise. Immediately thereafter, they are on the deployment side on the business. Then again, fundraise, deployment. Suddenly you realize you're in series F or E. And now suddenly you're looking at, IPO. And then whatever you have gone on building in terms of your governance structure, rights package, your own shareholding piece, various inter-se arrangements, they're all designed for a privately held company, which work very, very well in a privately held company. But suddenly all of it somebody will come from, say, the same firm from the capital market side and say, guys, this is something that doesn't work. Now, those conversations were very sudden when the switch happened from, privately held companies going M&A route, to a public listing approach, which happened a few years back. But now that has happened, all investors, founders, and everybody involved in the ecosystem, advisors, everybody has been telling from day one that, look guys, you need to plan for this eventuality. If you were to go IPO, then your structure has to look like this. One piece is reverse flip, right? Earlier, nobody really thought of India as a listing destination, and therefore, most companies would eye at an M&A abroad, fundraising abroad, listing on NASDAQ, right? So go to Singapore, take a YC check and go to US. And now suddenly everybody is coming back. And this realization also happened a few years back, 3-4 years back, where people suddenly sat and said, like, look guys, do we really need to go and take that YC check? Can we take some check in India? There's so many angel investors here. What are the pros and cons? Some SaaS company would come and say that, no, my market is in the US and therefore I need to be in US. And those real conversations happened as against people randomly and en masse structuring abroad. So those structure conversations happened earlier, which are now very, very serious. Anybody here who's, anything below Series C should actively sit back, think and assess the structure and see where are they headed, which is the jurisdiction they are in right now, where they should be. And I think those conversations are happening much, much earlier now.
So I think we have run out of time, but to kind of bring the conversation to a close, what we can understand is there's one point is there's cautious optimism in the market. Number two is if you are going public, be prepared for a tougher life. And number three is compliance is something that every startup should think of from day one at least, if not day zero. Maybe these are the biggest takeaways from today's conversation. Thank you everyone. Thank you panelists for being here
Can I
today.
just add one
yeah,
line?
Please.
So one new trend that we are looking at the overall scenario, a lot of global funds, okay, who are not looking India as a exit capital, okay, I think they are started believing that India is going to be the next IPO capital. So I can see that a lot of our counterparts, investors, are asking us how we can set up a fund in Gift City, okay, we want to allocate more on India. So that's a good news, yeah.
And a lot of funds on that, sorry, I know, a lot of funds who are not very, or whether corporate venture capital guys or venture capital guys or, whoever, everybody who said that, no, you get your company to Singapore or some other jurisdiction and I'll write the check tomorrow, have now started actively investing in India. And once they do a deal or two, then they realize it's not so bad, So both goes for fundraise as well as M&A. So I think that has also changed.
No, absolutely. In fact, I think on the policy front, there has been things that have
angel tax, for instance,
which has helped. Absolutely, we cannot deny that. And I think it's a very valid point that you brought up.
Yeah, imagine global funds asking us, can you connect us to someone in Gift City? Okay, we want to set up a fund here. Okay, they want to have more allocation, a smoother, inflow of their money. So
in fact, growth stage funds is very critical, right?
Yeah, growth stage fund I'm talking about. Yeah, for the first time we are looking at this trend. Otherwise, they were asking us, absolutely different thing. They were asking, ask your portfolio to set up a company in Singapore and US, and only then we'll invest.
There's so many growth fund guys who are doing roadshows in Bangalore, which would do roadshows in Singapore or somewhere else, and call the companies from Bangalore, if you're interested, please come and be a part of this there. Now they're coming, flying down here and doing roadshows and interacting with companies here because they know the companies will be here and go IPO also here.
I love the euphoria in the panel, which is reflective of the euphoria maybe in the sector, which is great. And I think it's a great note to close this conversation. Thank you very much, gentlemen. Thank you, audience.